Is Canadian National a buy or a sell? Let's get started with the model. This is a large cap company, 95 billion Canadian market cap. They're trading at $151 a share and they have 629 million shares outstanding. We're looking at the ticker that trades on the TSX. This stock does trade on New York Stock Exchange as well. Canadian National Railway provides rail services and trucking services. It transports cars, coal, fertilizers, temperature-controlled cargo, forest products, grain, minerals, chemicals, and consumer goods. They have a massive rail network of about 20,000 miles of track, founded in 1919, headquartered in Montreal, Quebec, Canada. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had 4 billion Canadian dollars in 2021, but it's going down each year, down to 3.6 billion in trailing 12 months. Still really good margins, 21%. They convert 21% of their revenue into free cash flow. But look how juicy it was in 2021, 28%. This means their expenses are growing faster than their revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that has a little upward trend from 4.9 billion to 5.6 billion. It did come down in the trailing 12 months to 5.4 billion. Solid margins, north of 30% each time period. Revenue is a sales for the company, and that looks real good from 14.5 billion to 17.2 billion. And they do pay a pretty sweet dividend, 2.25%. which they can afford. They can cover it almost 2 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 82 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of $74 billion. We divide that by 600 million shares. And we get a calculated stock price of 118. They're trading at 151, so they're trading at a 28% premium. It's a sell according to the model. What do you think? Do you think it's a buy or a sell? Let me know in the comments. There are 17 companies in the same industry as CNR, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. I converted their numbers to US dollars because all these other companies are trading in the US. So I wanted to compare apples for apples. That's why their market cap is lower than when we looked at it earlier. Because earlier it was in Canadian dollars, now it's in US dollars. 94 billion Canadian dollars is equal to 68 billion US dollars. All these companies have to spend a lot on CapEx because it's expensive to build out the infrastructure, the railways. They spend 2.5 billion, second highest on this list. Union Pacific is the highest at 3.6 billion. CP is Canadian Pacific. Their debt to equity ratio is better than the median average. For every dollar of equity, they have $1.10 of debt. Most people invest in railroad companies for the nice dividend. These are all railroad companies. I forgot to change the title. It still says Reed Healthcare Facilities. The biggest dividend is Trinity Industries, 3.4%. They're third highest in free cash flow. Union Pacific is number 1 at 5.5 billion. They rank third in market cap. Second, third, and fourth are real close. Union Pacific is the biggest by far. They're trading at 5 times book value. Price to book is stock price over book value per share. Rail Vision is the best at 0.4. Their PE is 17, which is better than the median average. Greenbrier is number 1 at 11.4. Somebody from Greenbrier contacted me and asked me to do a video on that company. So I made a video for 500 bucks. I wish more people contacted me about that stuff. Price to free cash flow is 25, that's the median. Freight Car America is number 1 at 1.2. They're trading at 5.5 times revenue. The way you calculate that, it's market cap, 68 billion, divided by revenue, 12 billion. And their 5-year annual revenue growth rate is equal to the median. Only CP is doing well in that category. If you put $10,000 into this company 10 years ago and reinvested the dividends, you'd have $19,000 today, a 6.5% annual return, an 88% total return. To summarize, I have them trading at a 28% premium, ranking 5 out of 10. I do like the company, so would I buy it? 7 out of 10. Ratios are about average. They're all pretty close to the median. Financials, also about average. Free cash flow is down 12% since 2021. Revenue is up 19%, which is a modest growth, probably just barely beating inflation. Let's look at their latest slides from their investor presentation. The ticker in the US is CNI. So if you live in the US, you want to invest, that's the ticker. The ticker on the TSX is CNR. Here's some high-level information. 25,000 employees, 108 billion market cap. These slides are a couple weeks old, so the market cap is down to 94 billion. This is Canadian dollars. 18,800 route miles, that's miles of track. 5.4 million car loads. Trailing 12-month revenue 17 billion, assets 53 billion. Capital investments 3.1 billion. Look at that free cash flow, 3.9 billion. They're a cash cow. Here are their tracks, which are in Canada and the US. They touch all the Canadian provinces, and they also touch a number of US states. Here's Chicago, Memphis, Tennessee. Here's a breakdown of the products they ship. Petroleum 19%, grain and fertilizer 19%, forest products 12%, autos 6%, metals and minerals 12%. Look at that, Martha Stewart is the CEO of this company. It looks like Martha from about 15 years ago. Their gross ton miles are going down, 1.3 billion in 2019, 1.2 billion in 2023. The cars are being used more. Each car covers 213 miles per day. That's up quite a bit from prior years. And the trains are faster, 20 miles an hour, which is the fastest ever. The great thing about rail is there's no traffic. When you ship by car or truck, there's a lot of delays. They're safer than ever before. Injury per 200,000 hours is below 1. I think that's the first time ever they're below 1. Accident rate is also down, 1.7 per million train miles. Here's a breakdown of the 16,000 employees. 4,000 conductors and yard coordinators, 2,000 locomotive engineers, 2,500 track forces, signals and communications 740, shopcraft 1,800. Shopcraft includes a lot of different things. It may include people working on maintenance, repairs, metalworking, and clerical is 1,500. Most of these employees are in unions. And here's another breakdown of the revenue, 6% coal. Intermodal is like moving a product from train to truck, or airplane to train to truck. There's more than one mode of transportation for that product. They have 7 major ports, and most of the traffic originates on their railway. Sometimes they use other companies' railways. The average product travels 700 miles. Here's a breakdown of their petroleum and chemicals division. 3.2 billion of revenue. The biggest is chemicals, 28%. Then natural gas liquids, NGL, 23%. Crude and heavy, 13%. Refined, 20%. Plastics and sulfur. Here's a breakdown of metals and minerals. 2 billion of revenue. This is for all of 2023. Metals, 32%. Minerals, 27%. Then you have sand, iron ore, and dimensional. A little under 2 billion of forest products. Half of that is lumber and panels. The other half is pulp and paper. 1 billion of revenue in coal. 1/3 is US coal, 2/3 Canadian coal. What do you like better, US coal, Canadian coal? 3.3 billion of grain and fertilizers. Half of that is Canadian grain, 1/4 US grain, potash 16% and fertilizers 8%. Their intermodal is 3.8 billion of revenue, 55% international, so that's US, 45% domestic, that's Canada. Automotive a little under 1 billion. Most of it is finished vehicles, 6% is vehicle parts. They shipped 1.6 million vehicles in 2023. They're working on 5 big projects. Their Fairview terminal expansion. Shovel ready is an advanced stage, so this should be done pretty soon. Can export should be done in 2026, that's under construction. That will help them load more resin and lumber. Their South Cayenne Logistics Park, that should be done next year, that's in development. Ridley Island should be done in 2026. And the second container terminal to be determined. That's going to add 2 million TEUs, 20-foot equivalent units. That means they're going to be able to ship 2 million more containers. Their revenue is growing a little bit. The CAGR is 3%. 2022 is similar to 2023, around 17 billion. But EPS is up. It's 8.53. That means they're buying back stock. The CAGR is 10%. Net income 5.6 billion. That's their highest ever. And free cash flow is down from 2022. It was 4.3 billion, now it's 3.9 billion. Pretty strong CAGR, 19%. CAGR is compound annual growth rate. CAGR is a good way to annualize their growth over a certain number of years. They're really consistent with their dividend payment. 28 consecutive years of dividend growth. It increased every year since their IPO in 1995. and they buy back a lot of stock. 35 billion of stock buyback since 2000. In 2023, it was 4.6 billion, similar to last year. Here are some financial highlights the past 5 years. Revenue, we saw earlier, 3% CAGR. Operating income, 4% CAGR. It was 6.8 billion in 2022. This year, 6.6 billion. Net income, 8% CAGR, 5.6 billion. Free cash flow, 18% CAGR, 3.9 billion. Stock buybacks in 2023, 4.6 billion. Before that, 4.7 billion. They're buying back so much more stock than prior years. In 2021, it was 1.6 billion. Really low in 2020, 379 million. That was the COVID year. 1.7 billion in 2019. Their return on invested capital, 14.5%. That's the return a company makes above what it pays for debt and equity financing. And you can see they grow their dividends each year, 1.5 billion to 2.1 billion. And they pay out roughly 40% of their net income as dividends. Very generous company. Here's a breakdown of their revenue the last 5 years by segment. Petroleum and chemicals, only a 1% CAGR. That was 19% of their total revenue. Metals has a 6% CAGR, 2 billion of revenue in 2023. That's 12% of their total revenue. Forest products, only 2% CAGR. Coal is the best. That's growing the most, 11%, over 1 billion in 2023. That's a pretty big jump from 2019. 2019, only 650 million. Grain and fertilizer, 8% CAGR, 19% of their total revenue. Intermodal is 23% of their revenue. Then you have autos, 6%. Let's take a look at a stock on Simply Wall Street. Its last price, 151, 95 billion market cap. It is down 2% in the past week, pretty much flat in the past year. Here's a stock price since 1997. It looks like it only goes up. This stock has done so well. And if you got it for below $20, then your yield is like 40-50% because your cost basis is so much lower than the people currently buying the stock. The peak was 180 in March. So it's down almost 20% since that peak, so it could be a great time to get in. Simply Wall Street's valuation is 160. They say the stock is 6% undervalued. 21 analysts priced this stock at 173. They say it's 15% undervalued. They definitely have a lot of debt on their balance sheet. It was 8 billion in 2013. Now it's at its highest point, 21 billion currently. Their equity is usually higher than their debt, but now their debt is a little higher. So that is a little concerning. And they don't keep much cash on their balance sheet, only $270 million. I wish I had $270 million on my balance sheet. They pay their next dividend on 12/29. You want to own the stock before 12/8 to get that dividend. Their yield in 2014 was kind of low, 1.3%. But it looks like it's been going up. Now it's 2%. The forecast for 2026 is 2.5%. The CEO's salary was under 1 million in 2022. Now it's 1.3 million. And her tenure as CEO is 3 years. In the past year, lots of insider buying and selling. Let's see the total shares. Insider sells about 385,000. Insider buys only 20,000 shares. 59% of the company is owned by institutions, 32% by the general public, 6% by hedge funds, and 3% by insiders. The Children's Investment Fund, a British company, is the biggest shareholder at 6.3%. Vanguard is second biggest, 3.6%. The Boston investment firm Wellington, 2.8%. Melinda Gates likes this company, 2.5%. That's the ex-wife of Bill Gates. Bank of Montreal, Royal Bank of Canada, Toronto Dominion Bank. The Toronto Investment Fund, 1832, owns 1.5%. So lots of big companies and banks own this stock. Their employee count was 24,000 in 2013. Now it's 25,000. And the ticker trades on the New York Stock Exchange, TSX, Deutsche Börse, Mexican Bolsa, Bulgaria, and Sao Paulo Bolsa. So if you really want to learn how to pick apart financial statements and be an investing guru, click on the video in the top right corner. Thanks for watching.